Join me as I dive into the craziness of Donald Trump's tariffs and see if I can uncover the most shocking market movements that follow. Trust me, you won't want to miss what we're about to explore. So, what's the big deal about Trump's tariffs? Well, since taking office, Donald Trump has been vocal about this plan to overhaul U.S. trade policies, focusing particularly by slapping tariffs on imports from various countries. These tariffs, which aim to protect American industries, reduce trade imbalances, and bring manufacturing jobs back to the U.S. But instead of a smooth sailing, it's been a bumpy ride for the stock market ever since. The tariff policies have created volatility, uncertainty, and some unexpected twists that have left investors on edge. But before we dive into the juicy stuff, let's set the stage and break down how these tariffs have caused major market fluctuations. We call this a tariff roller coasters. Trump's tariffs have been a significant source of uncertainty for both the US businesses as well as investors. For some industries, tariffs have been a threat to profits, while others they've been an opportunity. For investors, this has meant one thing: volatility. When tariffs are introduced or adjusted, it's not just the industries directly affected that feel the impact. The entire stock market can react sharply. Investors are often left facing many unknowns. How will the markets respond to the latest tariffs announcements? Which sectors will bear the brunt of the effects? Will the other countries retaliate? How will these moves impact corporate profits and ultimately the economy? How tariffs shake investors' sentiment. Tariffs are much more than just an economic policy. They are a trigger for investors' sentiment. In essence, the tariffs can make investors nervous. When trade tensions escalate, fear sets in and the nervousness spreads across the markets, causing stock prices to fluctuate wildly. When investors don't know what to do or what to expect next, they often retreat to safe assets, driving down stock prices and pushing up volatility. But why does investors' sentiments matter so much? Well, it can quickly become a self fulfilling prophecy. When the negative sentiment begins to take hold, it often leads to a panic selling, which further depresses the stock prices. In many ways, tariffs aren't just an economic event, they are an emotional one too. And when emotions take the wheel, things can get out of hand very quickly. Looking back at market reactions to the tariffs. So, what can we learn from the past experience with tariffs? Let's take a closer look at some specific examples of how markets reacted to Trump's tariff policies. One of the most notable sectors affected by the tariffs was the technology. When Trump first announced tariffs on Chinese goods, tech stocks took a significant hit. Companies like Apple, Intel, Qualcomm, firms that rely heavily on Chinese imports, saw their stock prices plummet. For these companies, the Chinese market is essential, and these tariffs threaten to raise their production costs and disrupt supply chains. Investors are quick to react, and the tech stock became one of the hardest hits. It wasn't just the tech industry that felt the effects, though. The automotive industry was another major casualty. When Trump imposed tariffs on imported steel and aluminum, U.S. automakers like Ford, General Motors saw their production costs rise sharply. Since cars require a significant amount of steel and aluminum, these tariffs put pressure on automakers' margins, causing their stock prices to take a hit. These companies face a double whammy as higher production costs combined with the possibility of lower demand in foreign markets made their outlook more uncertain. On the flip side, where some sectors actually saw benefit from these tariffs. Agriculture, for instance, saw an unexpected boost when China retaliated against U.S. agriculture products. The country imposed tariffs on products like soybeans, pork, corn, and as a result, U.S. farmers saw an uptick in demand for their goods, particularly in markets outside China. This was a rare silver lining in an otherwise turbulent economic landscape. The Mexico tariff tweet and its market impact. Now, let's talk about the key moment when a major market event occurred direct response to tariff changes. Do you remember when Trump tweeted about imposing tariffs on Mexico in 2019? It was a dramatic moment that caused the markets to go into full panic mode. On that day, Dow Jones Industrial Average plunged by more than 300 points, and the broader market followed suit. This event was a stark reminder of just how closely tied the stock market is to geopolitics. The announcement caused massive sell offs in the stocks across the board, as investors feared that a new trade conflict with Mexico could disrupt global supply chains, hurt U.S. exports, and reignited inflation. The market reaction was swift and severe, and it was a perfect example of how sensitive the markets are to tariffs announcements. So, why did the market react this way? In part, it was because of the potential consequences of such a move. Mexico is one of the U.S. largest trading partners, and the imposition of tariffs could have meant higher prices for U.S. consumers, disruptions to supply chains, and additional strain on the already fragile global economy. In essence, the fear of escalation of tariffs leading to a full blown trade war was enough to send investors running for the. It also underscored the unpredictability of Trump's tariff policies. Unlike the traditional calculated way of negotiating trade deals, Trump's unorthodox approach created an environment of constant uncertainty. Even new tweets of the tariff announcement seemed to spark panic in the markets, which only contributed to the market's volatility. The ongoing volatility and what it means for investors. In the aftermath of that event, investors were left scrambling, trying to figure out how to protect their portfolios from the potential fall. Many turned to safe havens, assets like gold, government bonds, while others diversified into less tariff sensitive industries like healthcare and utilities. One thing became clear, that the market would continue to be volatile as long as trade tensions remained high. Investors would need to stay nimble, constantly adjusting their strategies in response to the changing landscape of the tariffs and trade policies. For long term investors, this meant being ready for some unpredictable bumps along the way. What have we learned from tariffs volatility? So, what's the takeaway from all of this? Trump's tariffs have had a profound impact on the stock market, and it's been anything from a smooth ride. From the tech sector to the automotive industry, we've seen how difficult industries can be affected by trade policy shifts, and from the Mexico tariff tweet to retaliation actions from China. We've learned that the markets are highly sensitive to geopolitical tensions and trade uncertainty. The truth is, tariffs may be a tool to protect domestic industries, but they come with significant risk. They cause market fluctuations, disrupt supply chains, and change the outlook of industries and investors alike. As we've seen, the markets are highly reactive to trade news, and volatility can be overwhelming. Thanks for joining me on this journey into the world of Trump's tariffs. If you've got thoughts on how tariffs are impacting the markets, or if you think the trade war is overblown, leave a comment below. I'd love to hear your take on this, and thanks for watching.